Every day, millions of barrels of oil travel across borders, shaping not just the energy economies of nations, but also their political alignments, trade partnerships, and long-term strategic goals. In North America, Canada stands as one of the world's foremost energy exporters, possessing the third largest proven oil reserves after Venezuela and Saudi Arabia. While the United States is Canada's primary trading partner and by far the largest consumer of its crude, an interesting dynamic is unfolding. Several countries around the globe are increasingly relying on Canadian oil, sometimes even preferring it over oil from the United States. This shift highlights more than just logistics and pricing. It represents a growing awareness of the quality, reliability, and geopolitical neutrality associated with Canadian oil. Before we start, hit the like and subscribe buttons for more exclusive news. Take India, for instance, a rapidly growing economy and one of the world's largest oil importers. Traditionally reliant on Middle Eastern oil, India has been diversifying its sources to reduce dependency and increase supply stability. In recent years, Indian refineries have started importing heavier grades of crude from Canada, especially from Alberta's oil sands. These heavy crudes suit India's complex refining infrastructure, which is equipped to handle heavier, more sulfur-rich grades. While the United States has also exported oil to India, particularly after the lifting of its crude oil export ban in 2015, Canadian oil has gained an edge for its steady availability and Canada's lower geopolitical risk. With tensions between the US and various other global players fluctuating, Canada has emerged as a more politically neutral partner, offering a stable and predictable source of crude to fuel India's expanding energy needs. South Korea, another significant player in the global energy market, has likewise increased its imports of Canadian crude. The Port of Vancouver plays a critical role in facilitating these exports, as tankers loaded with Alberta crude head west across the Pacific to meet South Korea's energy demands. South Korea values Canadian oil not just for its quality, but also for its competitive pricing, especially compared to US crude, which can be influenced by domestic transportation bottlenecks and higher production costs. Moreover, Canadian oil arrives with fewer political strings attached. South Korea, which balances delicate diplomatic relationships with the US, China, and North Korea, finds Canadian energy imports a low-risk complement to its diversified energy policy. The recent increase in Canada-Korea energy trade reflects not only South Korea's strategic planning, but also Canada's growing role as a global energy supplier beyond its traditional US market. China, despite having a complex and often strained relationship with Western countries, has shown consistent interest in Canadian oil. Over the last decade, China has invested billions in Canada's oil sands projects through state-owned enterprises like CNOOC and Sinopec. While these investments have not always yielded smooth returns, due to regulatory hurdles and changing political climates, China's appetite for energy keeps it tethered to Canada's vast reserves. Even amid diplomatic tensions, trade in oil has continued. Canadian oil, shipped via the Trans Mountain Pipeline and loaded at ports like Burnaby, makes its way to Chinese refineries. China values the security of having oil from a country not mired in Middle Eastern instability or the US-led geopolitical sphere. Even though the United States is a major global oil producer, its increasingly protectionist energy policies and export preferences, focused heavily on allies, have prompted China to look north. Canadian oil, by contrast, is viewed as a more neutral and transactional resource, making it appealing to a country seeking energy security amid great power competition. Then there is Italy, a less obvious but increasingly important consumer of Canadian oil. Italy's Eni, one of Europe's largest energy companies, has explored partnerships and spot market purchases of Canadian crude, particularly from offshore Atlantic reserves like those found off the coast of Newfoundland and Labrador. This light sweet crude is highly desirable in European refineries that are configured for lighter grades. In recent years, Canada has increased shipments to European countries as they attempt to wean themselves off Russian energy supplies following the invasion of Ukraine. While the US has been a supplier to Europe as well, much of its oil and liquefied natural gas, LNG, is consumed domestically or committed to key NATO allies like Germany and Poland. Italy, with its own distinct energy needs and refinery configurations, finds Canadian offshore crude an optimal fit. Moreover, Canadian crude is viewed favorably in terms of environmental and ethical production standards compared to Middle Eastern or Russian sources, an important factor in a European Union increasingly focused on sustainability and ESG, environmental social governance metrics. Japan provides another compelling case of a country leaning more toward Canadian oil over U.S. supplies. Japan's energy landscape is shaped by its lack of domestic resources and its vulnerability to geopolitical disruptions in the Middle East and Southeast Asia. As a result, Japan has pursued a strategy of energy diversification, with Canada rising as a key partner. In particular, Canada's West Coast export terminals, such as the expanding Trans Mountain Pipeline system and the proposed LNG Canada project, are being developed with Asian markets like Japan in mind. Japanese firms have participated in some of these projects directly, signaling their commitment to securing long-term supply agreements. While the U.S. is geographically closer and a long-standing ally, Japan sees Canadian oil and gas as an important hedge, offering consistent supply without the entanglements of U.S. domestic political shifts or export constraints. Furthermore, Canadian oil's reputation for ethical sourcing and labor rights appeals strongly to Japanese corporations bound by strict corporate governance and reputational concerns. Germany's pivot toward Canadian oil has been driven largely by necessity and reinforced by long-term strategic planning. Once a major consumer of Russian oil and gas, Germany has undergone a dramatic shift in its energy sourcing since the Russian invasion of Ukraine. Faced with the urgent need to replace Russian hydrocarbons, Germany accelerated its search for dependable alternatives. While the United States has helped fill some of this gap with LNG and light crude, Canadian oil offers qualities that better suit certain German refineries, particularly when it comes to medium and heavy crude blends. Moreover, Germany has been motivated by a desire to partner with nations that align with its values on climate action and human rights. Canadian oil, increasingly produced under stringent environmental regulations and carbon management systems, presents an ethical choice. And whereas U.S. energy policy has become subject to rapid and dramatic shifts depending on the political party in power, Canada offers a more stable, long-term partner. Germany's industrial economy, especially its manufacturing sector, relies on consistent, long-range planning, and Canadian oil meets that requirement more predictably. In the Netherlands, Canadian oil plays an important role in the broader European energy mix. The Port of Rotterdam, Europe's largest energy and commodities hub, regularly receives shipments of crude from across the globe. Among these, Canadian oil has become a more prominent player in recent years. The Netherlands, like many EU nations, has sought to decouple its energy dependency from autocratic regimes and to diversify its import sources. Canadian crude appeals for several reasons. Its environmental record, while not perfect, is more transparent and accountable than that of most other large oil-producing nations. Canadian companies are subject to strict regulatory oversight, and their operations must meet standards not just at home, but also to satisfy international buyers increasingly governed by ESG mandates. Additionally, Canada's growing capacity to export through Atlantic terminals like those in Newfoundland offers the Netherlands a direct transatlantic supply line, shortening delivery times and reducing risk of geopolitical disruptions along traditional shipping routes. U.S. oil exports, while substantial, are often constrained by Gulf Coast congestion, hurricanes, and shifting policy landscapes. For Dutch importers and refinery operators, the reliability and predictability of Canadian shipments are key advantages. Singapore, a global trading hub and one of Asia's most strategic oil refiners and re-exporters, represents a different yet equally compelling case. Unlike energy-hungry nations that primarily import oil for domestic consumption, Singapore processes oil for refining and redistribution across Southeast Asia. In doing so, it evaluates crude sources based on not only cost and accessibility, but also refining yield and political risk. Canadian oil, particularly blends like Western Canadian Select, WCS, has carved out a space within Singapore's supply chain due to its consistent quality and attractive pricing. Although Singapore also imports from the U.S., fluctuations in U.S. domestic policy, port delays, and occasional export bans have made American oil less predictable in comparison. Canadian crude, on the other hand, benefits from long-term contractual reliability and fewer diplomatic disruptions. Furthermore, as Singapore positions itself as a green energy leader within Asia, Its emphasis on responsible sourcing makes Canadian oil, produced under some of the world's strictest environmental standards, a more compatible option than oil from politically volatile or environmentally negligent regimes. The United Kingdom, especially in the wake of Brexit, has been actively redefining its trade relationships, including in the energy sector. With North Sea production declining and the need to ensure a stable energy mix growing more urgent, the UK has expanded its import portfolio. Canadian crude, particularly from the Atlantic offshore reserves, has become increasingly relevant. These crudes are light, sweet, and well suited to British refineries, many of which were designed to process similar grades. The political dimension is also important, as Britain looks to secure energy outside of the European Union and beyond its traditional dependencies. Canada emerges as a natural ally, English-speaking, democratic, and bound by a shared legacy of trade and legal institutions. While the US shares many of these qualities, the UK has found Canadian energy policy more consistent and less vulnerable to the partisan swings that characterize American governance. There is also a reputational component. For British companies and the government, investing in or importing from Canada carries less risk of backlash than doing so with countries known for human rights violations or environmental degradation. In a public relations environment that is increasingly unforgiving, sourcing from Canada is a politically safer move. Spain, too, has found new value in Canadian oil, especially as it has sought to diversify away from North African and Middle Eastern suppliers. Spanish energy companies like Repsol have complex refineries capable of handling a wide range of crude types. While U.S. oil does enter the Spanish market, Canada offers two distinctive benefits. First, its heavy crudes align with Spain's sophisticated refinery configurations, yielding high-value products like diesel and aviation fuel. Second, Spain's shipping routes and port infrastructure on the Atlantic coast are well positioned to receive Canadian crude efficiently. Given the geopolitical unpredictability of other suppliers, particularly in the Maghreb and Sahel regions, Canadian oil is seen as a premium choice, not necessarily cheaper but more secure, consistent, and aligned with long-term European Union objectives for climate and governance. Spain's increasing investments in renewable energy sources further push its fossil fuel portfolio toward cleaner and more ethically sourced hydrocarbons, criteria where Canada again scores higher than many of its competitors, including the United States. Each of these countries has its own calculus, but they all reflect a common reality. Canadian oil is no longer just a regional asset. It is a global commodity being chosen deliberately over U.S. alternatives. Part of this appeal lies in the infrastructure improvements Canada has made over the past decade. From expanded capacity at the Port of St. John in New Brunswick to the Trans Mountain Pipeline expansion in British Columbia, Canada has enhanced its ability to reach both Atlantic and Pacific markets. These developments reduce dependency on American infrastructure for export and allow direct relationships between Canadian producers and international buyers. Equally important is Canada's political consistency in energy policy. While debates exist over pipelines, emissions, and the future of fossil fuels, Canada's overall direction remains broadly supportive of the oil and gas sector, even while pursuing aggressive climate goals. This balance reassures foreign governments and corporations that their energy relationships with Canada won't be upended by sudden policy shifts or isolationist trade moves. The United States, on the other hand, has alternated between oil-friendly and restrictive administrations, leaving trading partners wary of long-term agreements that could be derailed by the next election cycle. Another dimension worth noting is the international perception of Canada's Indigenous and labor policies in resource extraction. While challenges and controversies persist, Canada maintains a relatively high standard in engaging Indigenous communities and protecting labor rights in its oil sector. For countries and corporations with strong commitments to corporate social responsibility, this is more than symbolic, it's essential. Importing oil from Canada allows governments and companies to demonstrate alignment with ethical sourcing standards, something that is far more difficult when dealing with oil from autocracies or conflict zones. Furthermore, Canadian oil projects often integrate with global investment portfolios. Many of the same nations importing Canadian crude are also stakeholders in Canadian energy ventures. Germany's investment banks, UK-based pension funds, and Dutch infrastructure investors have financial interests in Canadian midstream and upstream operations. This convergence of trade and investment strengthens the rationale for preferring Canadian oil. Reinforcing economic ties, that extend beyond simple buyer-seller arrangements. With shared financial interests comes shared risk and opportunity, creating a powerful incentive to sustain and expand these energy relationships. Technology also plays a role in the appeal. Canada has been a leader in advancing oil sands technology, emissions tracking, and carbon capture initiatives. Countries with progressive energy policies and technological mandates like Singapore and Germany value these efforts. Importing oil from Canada allows them to integrate more clean technology and data transparency into their supply chains. In contrast, U.S. producers, particularly in states with looser environmental regulations, may lag in these areas or lack the same levels of disclosure. The expanding role of Canadian oil on the world stage is a reflection not just of physical barrels but of trust, alignment, and reputation. Germany's strategic recalibration, the Netherlands' refining logic, Singapore's hub economics, the UK's post-Brexit autonomy, and Spain's energy independence efforts all point to a broader shift in how nations think about oil. It is no longer just a commodity. It is a mirror of international values, supply chain ethics, and diplomatic predictability. And in this new paradigm, Canada is standing taller than ever before. While the United States continues to wield significant power in the global oil trade, its political volatility, infrastructure bottlenecks, and at times mercurial trade policies have left space for other players to rise. Canada, with its rich reserves, maturing export capabilities, and globally respected governance frameworks, has stepped confidently into that space. Countries that once looked primarily to the U.S. for energy solutions are increasingly choosing Canada, not just for what it extracts from the ground, but for how it operates, governs, and partners. The preference for Canadian oil in these countries, India, South Korea, China, Italy, and Japan, rests on a combination of strategic, economic, and geopolitical factors. Each country seeks not only energy security but also diversification, supply reliability, and minimal political entanglements. Canada, unlike the United States, positions itself as a relatively apolitical supplier. The U.S., while an energy superpower in its own right, often wields energy exports as a tool of foreign policy, offering preferential terms to allies and cutting off adversaries. Canada, by contrast, markets its resources with fewer strategic strings, making it attractive to a wider range of global customers. Another reason for this growing preference lies in logistical evolution. Canada's investments in infrastructure, such as expanded port facilities in British Columbia and enhanced rail connectivity, have increased its ability to export efficiently. While the United States has vast export capacity through the Gulf Coast and major pipelines, Canadian infrastructure is catching up and, in some cases, offering faster access to Asian markets. The opening of new terminals and shipping routes has made it feasible for Canadian oil to be more than just a continental commodity. It is now a globally traded resource. Environmental standards and ethical considerations also shape this dynamic. Despite criticisms of Canada's oil sands as carbon-intensive, Canadian producers are increasingly focused on carbon capture technologies, ESG compliance, and transparent regulatory oversight. These factors resonate with global importers, especially in democratic or environmentally conscious countries. U.S. oil production, dominated by shale plays, often faces criticisms over fracking, methane emissions, and inconsistent state-level regulations. In contrast, Canada's more centralized and regulated approach offers assurance to governments and corporations that must answer to their constituents or boards on the environmental and social impacts of their supply chains. Pricing, while not always the leading factor, also plays a role. Canadian crude has historically been priced at a discount to global benchmarks due to transportation limitations and storage issues, known as the Western Canadian Select (WCS) discount. For many importers, this represents a value opportunity. By purchasing Canadian crude at competitive rates, countries can reduce their energy bills while still securing a reliable and high-quality product. As pipeline bottlenecks are eased and terminal capacity grows, this price advantage may diminish somewhat, but it remains a compelling incentive for countries balancing budgetary constraints with energy demands. Geopolitics has further elevated Canada's profile in global oil trade. The Russian invasion of Ukraine, the volatility in the Middle East, and the increasing unpredictability of U.S. foreign policy have all nudged countries toward suppliers perceived as more stable and neutral. Canada's diplomatic posture is generally collaborative, and its foreign relations are less likely to be the cause of embargoes, sanctions, or retaliatory disruptions. This sense of dependability matters deeply to energy-importing countries, which structure their entire economies around continuous access to fossil fuels. If you liked this video, please give it a like and subscribe to our channel. Also, could you leave your comments below and tell us, what are your thoughts on 10 countries choosing Canadian oil over US? Why is that? We want to hear from you. Thank you for watching and see you next time.